The global financial system is built on trust, trust in institutions, in the integrity of markets, and in the promise that debt issued today will be repaid tomorrow. At the center of that trust stands the U.S. Treasury market, deep, liquid, globally referenced. But what happens when that foundation begins to show cracks? In this video, we explore how the U.S. debt market, long considered a rock-solid safe haven, is now revealing signs of fragility, creating risks not just for America, but for the entire world. The title says it all: the collapse of trust. Trust in the U.S. debt market is more than a domestic concern. It is a global concern, because the U.S. Treasury market underpins global finance. It sets benchmarks for yields. It offers collateral. It anchors the dollar's reserve currency role. When trust falters, the ripple effects are enormous. Let's set the scene. Over decades, the U.S. federal government has borrowed trillions of dollars, running deficits and issuing bonds of varying maturities. The total outstanding federal debt has grown tremendously. According to one recent analysis, U.S. national debt surpassed $36 trillion and reached roughly 119% of GDP, raising concerns about fiscal sustainability. But debt size is only part of the story. What truly matters is investor confidence, the willingness of global markets to buy and hold U.S. Treasuries, to accept the dollar as reserve currency, and to rely on the U.S. debt market as a safe harbor. Recent signals show that confidence is being tested. For example, substantial proportions of U.S. debt are now market-held rather than intragovernmental, which means exposure to global investor sentiment is higher. What triggers a collapse of trust in a debt market? Several factors: rapid debt accumulation, rising interest servicing costs, declining fiscal space, rating agency downgrades, changes in investor demand, macroeconomic stresses, or a shock that reveals vulnerabilities. We will explore each of these in due course. Why does this matter globally? Because when the U.S. debt market falters, yields rise, the dollar weakens, global bond markets are impacted, emerging economies feel the spillover, and financial stability can be threatened. One recent scenario analysis suggests that if U.S. debt stress leads to rising yields, global multi-asset portfolios could see losses up to 14% under certain scenarios. In short, the U.S. debt market is no longer simply a domestic issue. It is a global risk. Over the next sections, we will unpack how the U.S. debt market evolved, how trust was built, how cracks are forming, what the global ramifications are, and what might happen next. So buckle up. This is a deep dive into the collapse of trust, the mechanics of the U.S. debt market, and why the world should care. To understand current vulnerabilities, we must look back at how the U.S. debt market rose to global dominance. The story begins with the U.S. dollar as the world's reserve currency, the deep capital markets of the United States, and the design of the Treasury market as safe, liquid, and trusted. After World War II, the U.S. emerged as economic powerhouse. The dollar's link to global trade, and later its status as the prime reserve currency, gave U.S. Treasuries special significance. The pool of global investors, sovereign wealth funds, central banks, pension funds, relies on high-quality, liquid assets, and U.S. Treasuries filled that role. Over time, the Treasury market grew in size, complexity, and centrality. The depth, billions in daily trading, the maturity structure, short, medium, long-term, and the implicit backing by the U.S. government created the perception of risk-free assets, though risk-free is an economic abstraction, not a guarantee. The global financial architecture built around the U.S. bond market means many instruments reference U.S. yields, many contracts use U.S. Treasuries as collateral, and many international investors use U.S. assets for safety, diversification, or regulatory requirements. But how do we get here? Key drivers: strong economic growth, institutional investors trusting U.S. institutions, a flexible currency, deep markets, rank-and-file investor demand. For decades, this system operated smoothly. However, the foundations are not indestructible. When the U.S. starts issuing debt at accelerating rates, when deficits widen, when demographic and economic trends slow growth, the question becomes, does supply begin to outstrip demand? Are the safe haven flows still automatic? Some analysts say no. In one insight piece, it was stated that while U.S. debt burdens are high, investors still see Treasuries as the best option, but that could change. What emerges from this historical view is a dependency. The global system depends on the U.S. debt market operating smoothly, and the U.S. benefits from exorbitant privilege, the ability to issue debt cheaply, borrow in its own currency, and maintain reserve status. But with privilege comes responsibility and risk. In the next part, we'll look at the current state of the U.S. debt market, size, composition, servicing costs, investor base, and identify the warning signals. Trust does not erode overnight. It erodes through warning signs, slow but persistent. Let's examine the early signals in the U.S. debt market that indicate the possibility of a collapse of trust. First, the sheer size and pace of debt accumulation. The U.S. government debt has grown rapidly. One recent article cautions that the rising debt may cast a fiscal shadow. As debt to GDP ratios climb, servicing costs rise, and market-held debt increases. Market-held debt means the government is more exposed to investor sentiment shifts. Second, interest servicing costs. As more debt is issued and yields stay elevated, the cost to service existing debt consumes larger parts of the federal budget. Once interest payments approach or exceed major policy expenditures, the fiscal space is diminished. Deloitte. Third, rating agency actions and global investor behavior. In May 2025, Moody's downgraded U.S. sovereign credit, signaling that debt levels and governance were impacting global leadership and risk perceptions. Fourth, shifting demand dynamics. While the U.S. still issues vast amounts of treasuries, the global pool of buyers is under pressure. The depth and liquidity that once seemed inexhaustible may face limits in times of stress. This raises questions. What happens if demand falls when supply rises? Fifth, spillover risks. The U.S. Treasury market is interconnected with the global financial system. A shock in the U.S. market, rising yields, dollar depreciation, investor flight can transmit rapidly abroad. One analysis shows that emerging markets are vulnerable to U.S. rate moves and debt stress. In sum, the warning lights are flashing. The system may still be functioning, but the margin for error is narrowing. In the next part, we'll analyze how global trust is linked to the U.S. debt market and what happens when that trust falters. The U.S. debt market is not an isolated corner of the economy. Its functioning underpins global finance. Therefore, trust erosion in this market has vast global ramifications. Let's examine some key channels of contagion. Channel 1. Global bond yields and cost of borrowing. If U.S. Treasury yields rise due to higher risk, countries and corporations globally face higher borrowing costs because many debt instruments reference U.S. benchmarks. This could slow investment and growth globally. Channel 2. Dollar-centric finance and reserve status. The U.S. dollar's reserve currency role depends on faith in U.S. fiscal and financial stability. If trust erodes, investors may seek alternatives, reducing demand for U.S. assets and putting downward pressure on the dollar. Channel 3. Spill over into emerging markets. Many emerging markets are heavily sensitive to U.S. rate movements, dollar strength, and global investor sentiment. A shock in the U.S. Treasuries market could trigger currency crises, capital flight, or debt servicing stress in vulnerable countries. Channel 4. Collateral and systemic risk. U.S. Treasuries are used as collateral across financial markets. If their value falls or liquidity dries up, it could impair collateral chains, increase margin calls, and provoke market stress. Channel 5. Confidence and safe haven flows. When trust in U.S. debt wanes, investors lose confidence in the safe part of safe haven assets. This undermines global risk management frameworks and can increase systemic fragility. To illustrate, one scenario analysis estimates that under a rising yield stress on the U.S. market, a global multi-asset class portfolio could lose up to 14%. Moreover, the International Monetary Fund and others warn that rising U.S. deficits and debt levels pose significant risks to the global economy. Therefore, the collapse of trust in the U.S. debt market is not a theoretical possibility, it's a practical global risk. And yet, it receives less attention than it deserves.
In the next part, we will dig into real-world stress points, debt ceiling fights, maturity walls, demand slippage, structural vulnerability.
Let's explore the most acute stress points of the U.S. debt market, the vulnerabilities that could trigger the collapse of trust. Vulnerability 1. Debt ceiling and political stalemate. The U.S. debt ceiling fights have repeatedly brought the world to the brink of default risk. Markets react to uncertainty. If Congress fails to raise the ceiling, the U.S. could technically default on its obligations, which would be catastrophic for global confidence. Vulnerability 2. Maturity wall and refinancing risk. The U.S. issue size is enormous, and maturity profiles lengthen. With large volumes of Treasuries maturing and being rolled over, there is refinancing risk. If demand weakens, yields need to rise to attract buyers. Vulnerability 3. Investor base shifts. Historically, foreigners and central banks held large amounts of Treasuries, but in recent times, the domestic holding and market-held proportions have increased, making the market more dependent on investor sentiment and less on institutional stability. Vulnerability 4. Interest rate risk and inflation. Rising inflation and rising real yields can erode the value of fixed income assets. If the U.S. cannot grow fast enough to service rising debt, yields will rise and the cycle worsens. One risk scenario shows that if yield demands rise, portfolios can lose significant value. Vulnerability 5. Alternative safe havens and de-dollarization. If investors lose faith in Treasuries, they may move away from dollar-based assets to alternative currencies or assets. That, in turn, weakens the dollar and reduces the U.S.'s exorbitant privilege. Vulnerability 6. Collateral and liquidity stress. If Treasuries lose their safe haven status, liquidity can vanish quickly in stress scenarios. As one global analysis shows, shifts in U.S. safe haven behavior can trigger market instability. Each of these stress points is manageable in isolation, but together they create a risk web. The question is not whether there will be turbulence, but how large and how global its effects may be. In the next part, we will walk through several plausible scenarios for a collapse of trust in the U.S. debt market, ranging from manageable correction to full-blown global crisis.
Forewarned is forearmed. Let us examine plausible scenarios if trust in the U.S. debt market collapses and what the implications for global finance could be. Scenario A. Gradual confidence erosion. In this scenario, the U.S. continues to issue large amounts of debt. Investor demand weakens slightly, yields gradually climb, the dollar weakens modestly, and global investors diversify. The result? Slightly higher borrowing costs for the U.S., a modest de-anchoring of global safe haven flows, and painful but contained market adjustments. Scenario B. Triggered shock. A political stalemate on the debt ceiling or a sudden spike in yields leads to a flight from U.S. Treasuries. The dollar falls, yields rise sharply, global bond markets sell off. A global risk event occurs. Emerging markets suffer, collateral chains break, liquidity dries, and the U.S. becomes less able to borrow cheaply. This could shave double-digit percentages off global portfolios. Scenario C. Systemic crisis. The worst case. The U.S. defaults, even if briefly, trust collapses, Treasuries lose safe haven status, the dollar falls majorly, global de-risking accelerates, credit dislocations spread, and the world enters a debt market crisis akin to 2008, but debt market-centered. Each scenario has cascading effects: higher global yields, currency volatility, capital flight, increased cost of borrowing for governments and corporations, slower global growth, and destabilized financial markets. That is why many major asset managers and institutions are warning that rising U.S. debt is the greatest risk to global markets. For viewers, this is not just about U.S. fiscal policy. It is about global financial architecture. Your investments, pensions, national economies, and market stability hinge on trust in the U.S. debt market. In the next part, we will look at what can be done: mitigation, reform, and resilience.
The risk is real, but not inevitable. Let's consider what can be done to restore or maintain trust in the U.S. debt market and what resilience global finance needs. Action 1. Fiscal consolidation and credible plans. The U.S. needs to show it can manage deficits, curb debt growth, and maintain budget credibility. When deficits persist and debt accumulates unchecked, markets become skeptical. Analysts emphasize that long-term planning is essential. Action 2. Transparent investor communication and debt management. The Treasury needs to manage issuance carefully, maintain depth and liquidity, and ensure that Treasuries remain attractive. Market participants need clarity on supply and demand. Action 3. Strengthening the investor base. Encouraging domestic savings, continuing strong foreign investor participation, maintaining high credit standards, and guarding the safe haven standing of Treasuries are key. Action 4. Global coordination. Since the U.S. debt market is global, policy coordination matters. Reserve currency status is partly built on global trust, and global institutions can help maintain confidence. Action 5. Coping with alternative architectures. The world is evolving. New safe havens, digital currencies, regional financial systems. The U.S. must adapt and ensure its debt market remains relevant and trusted in this changing environment. Action 6. Scenario preparedness and stress testing. Markets need to stress test for situations where Treasuries lose their safe haven status, collateral chains falter, liquidity evaporates. Proactive resilience measures can prevent panic. For investors, governments, and individuals, the signal is clear. Trust is not automatic. It must be earned and maintained. The U.S. debt market's future matters, and your financial future may in fact depend on it. We've traveled through the architecture of global trust, the dominance of the U.S. debt market, the warning signs, the global ramifications, the scenarios, and the pathways to resilience. Now it's time to draw conclusions and emphasize what this means for you, the viewer, the investor, the citizen, the global stakeholder. Trust in the U.S. debt market is not guaranteed. It has been built over decades, but is subject to erosion through fiscal missteps, institutional weakness, investorships, and global competition. A collapse of trust has global impact, not just higher U.S. yields, but weaker dollar, stressed emerging markets, liquidity issues in global bond markets, collateral breakdowns, and slower global growth. The U.S. enjoys advantages, borrowing in its own currency, deep markets, but these advantages do not absolve risk. The stress points we discuss, debt ceiling fights, refinancing risk, yield pressure, investor base shifts, are real and increasingly visible. You have agency. As an investor, diversify your holdings, monitor U.S. debt signals, understand global bond market interconnections. As a citizen, recognize that national fiscal policy and debt issuance have global repercussions and advocate for transparency and resilience. As a global stakeholder, understand how shifts in one market can ripple across continents. Don't assume safe means riskless. Stay informed. Watch the signals: rising yields, weakening dollar, large supply of treasuries, shrinking foreign demand, rating agency commentary. Ask tough questions about debt. How sustainable is it? Who is buying? What happens if demand fades? The U.S. debt market is a pillar of global finance. If that pillar falters, the architecture shakes. The collapse of trust is not inevitable, but neither is it impossible. The world is watching. Will trust hold,
or will we see a new chapter of global risk? Thank you for joining this deep dive on the collapse of trust, how the U.S. debt market became a global risk. If you found this valuable, please like, subscribe, hit the bell, and join the conversation in the comments. What surprised you most? How do you think your country would be affected if U.S. Treasuries lost their safe haven status? Until next time on Financial Time Capsule.